This is a scenario where you have a married couple lives in New York City. They have 3 kids, um, high income, net worth of only $5 million, so not a crazy high number. They set up Crummey Trust for each of their 3 kids, and they make the $36,000 gifts each year. So if you look at the chart, so if they don't set up a Crummey Trust, then obviously there's no Crummey Trust savings. But if they do set up a Crummey Trust in year 25, and they die in year 25, they will have saved their children about $5.5 million of state tax, just by moving assets out of their state into the Crummey Trust. And if they die in year 50, they will actually have saved about $53.5 million of estate tax for their kids. The exact number is sensitive to certain assumptions, but it's going to be somewhere in that range. This is assuming 9% pre-tax IRR.
And this is really, again, like, I know these numbers are fairly massive when you're thinking about, in this case of 3 kids, each parent, they're gifting, it's $108,000 per year. These numbers really get big. And now, by the way, this isn't the total value they're passing on. This is how much they avoid in estate taxes. Yeah. So it's incremental. It's essentially either giving this money to the government or passing this on to your kids. It's not the total value of what they pass on to the kids. It's the incremental. And this really value comes from, one is, Peter mentioned this, is you move these assets outside of your state. And so all the growth is gifts and estate tax free. And then secondly, because you can pay the taxes on the income from this trust, you're reducing the size of your estate, and so reducing any future gift and estate taxes. And by you paying those taxes, the trust / your kids and future generations get that money instead. And again, this is really, to make it explicit, it's either giving money, using this as reducing the money you give to the government when you pass away, and giving more to your kids or grandkids.
Yeah, and so the other thing that people notice is that it's not a linear difference between year 25 and year 50. That's actually true of a lot of tax strategies. They tend to compound.
To be fair, it's true of probably almost any financial thing. If there's anything, it's the Einstein quote is like, compounding is what's the 8th wonder of the world. Everything in finance, tax is compounding in some sense. And so, probably one takeaway is doing this sooner rather than later has compounding benefits.